In this video, we'll be taking a look at ROST Store's stock, which is ROST. They're a discount department store. You may have seen some around you. Their stock is currently around $90 with a P/E ratio of almost 35. They currently pay a 1.275% dividend yield with their current stock price. I'm going to start with an intro to the company and their operations, which might be a little bit boring, but then I'll be taking a look at their numbers, which are way more exciting in my opinion, and why I kind of picked this stock to take a look at. I will be getting most of this information off their investor relations site. They have an annual report and a presentation on there. From their, I think, annual report, they kind of introduced the company as two brands, the ROST brand and the DD discounts. For the ROST, they have 1,500 plus stores in 39 states, and the DD discount, it's like 250 in 19 states. Their first brand, the ROST brand, tends to be big stores, 22,000 square feet or higher, geared more towards the individual and kind of in high traffic areas. Their DD's discount stores tend to be more family oriented and smaller stores than ROST. They kind of give you a merchandise breakdown as well. Most of it is apparel with some home. They also give you a breakdown as far as where their stores are located. And as you can see, they're kind of mainly located in California, Texas, and Florida, which happen to be the states that have the most coronavirus cases at the moment. Now to go into more factors as to why ROST caught my attention as a stock. If you take a look at their revenue and their net income, you can kind of see that it's been steadily increasing since like forever. I pull these graphs off macrotrends.com. And these trends kind of surprise me, as most discount retailers are kind of struggling to keep up with Amazon, whereas ROST is continually growing. Obviously they had that dip because of Corona and having to close, but other than that, it's been pretty steady as far as increasing revenue. Also, if you plot their last 8 years of revenue and net income, you can see that they're kind of averaging a 7% increase in revenue and 11% in net income, which is pretty good numbers. You should also take a look at their balance sheet. I took this report from their latest filing starting in May. As you can see, they kind of have some cash now. If you took a look at the start of 2020, which is normally what they would hold in debt, it's pretty much nothing. But as you can see from the long-term debt line, they took on some debt that's mainly just to provide liquidity while they are kind of going through this uncertain time with their stores. And this increased debt isn't that concerning, mainly because last year they had a net income of 1.6 billion. So it's debt they can easily afford in the long run, and they tend to run a pretty low debt model. So I think they'll probably be paying that pretty aggressively once they are in the clear and no longer kind of need that safety net. And the next number I'm looking at is their ROIC, which is return on invested capital, which is kind of a good measure of seeing how efficient the company is in investing their capital. So it's kind of a measurement of like what management is doing and if they have the right strategy. And given that they're growing, I would probably say that they do have the right strategy, but the ROIC kind of reflects that, and it's a good number to compare against their WACC. Their WACC is their weighted average cost of capital, which is basically how much it would cost the company to take on more capital, usually in the form of debt. Ideally, you would want to find a company that has a higher ROIC over a WACC, meaning they can invest capital more efficiently than it costs them to take it on, so that they can keep producing returns on it. And you can look at ROST's ROIC on GuruFocus.com, and you can see that it's trailing 12 months is 14%, with a dip of negative 17%, obviously because of COVID and it was closed, but their ROIC, even with that hit, is still significantly higher than their WACC. Next, I'll be taking a look at their dividend. I'll be looking at that via seekingalpha.com. They have a dividends tab. And if you can take a look at the scorecard, they've been growing their dividend for 25 years. Their payout ratio is over 100 right now, but if you look at it historically, it seems to be in the lower 20s, which kind of indicates that they can easily pay it and grow it more. So all those numbers look good. The last step for me was to kind of do a discounted cash flow model. I won't be going over how to do that in this video, mainly because it's covered all over the internet. But when I did mine, I get a value of pretty much what the stock is at, or a little bit more, but not that much more. Ideally, you will want a buffer of at least 30% of what you get from a discounted cash flow to what the market's pricing the stock at right now. That way you kind of have some buffer in there if you made a mistake or didn't see something in their reports. So basically the market's saying that it's all going to be fine. And you can gather that from the P/E ratio of 35 as well from the intro of the video, which in my opinion is a bit optimistic at the moment, seeing as pretty much we're not really past COVID and they really have no e-commerce play, so they're kind of just relying on the stores being open in case of going down. So I probably will wait a while to see if there's a second crash, and this probably will be one of the stocks I grab first, because currently the stock is only about 25-30% off the all-time highs. So I think it's just a little bit optimistic for right now. But it definitely has a lot of good numbers to keep on my watch list as a long-term dividend play, so I'll keep an eye on it. If you have any questions on the concepts or numbers that I covered, ask in the comments. And if you'd like to see more videos like this, subscribe to the channel. Catch you guys next time.